There we go. So daily chart looks like we're going to form a bull bar for the follow through, and that's good for the bulls. I think overall, I believe what I said in the blog. I'm pretty sure I'd have to go back and check, but I'm pretty sure I made the comment that the bears, even if today's a disappointing follow through bar for the bulls, which today is, that's not the entry bar that you really want to see, and that's no surprise because we're in a trading range. But even if we do get a disappointing entry bar for the bulls, it's probably a bad stop order sell for the bears. And what that means is that there's probably traders buying below the low of the bar, which increases the odds that we get some kind of second leg up. So for the bulls or the bears, what do you do here? I think the bears, it's a low probability sell below and increase the odds there's buyers scaling in lower. Now, what are the chances that today is going to be similar to this bar? I believe that was Thursday, March the 5th. So March the 5th, we had a doji, and instead of finding buyers below it, what happened? We broke even lower and then went a little bit lower here. What's the chances that this is going to happen here? I think it's lower. The bears have had a lot of opportunities to try and break to the downside, and they're failing. And we have a lot of buying pressure here. This certainly does not look like good selling. Every time, if you think about it, we gapped down, rallied, gap down here, rallied, and then gap down here, rallied. So we're gapping down, but not getting strong selling on the gaps. That's a sign that the market's more bullish than bearish. This is a trading range. And if you just zoom out, we have a lot of trading range price action all through here. The traders buying. And really what I was going to show, let me just show it on the weekly chart. You can kind of see it here. This is fairly bullish, and this is neutral, but it's following a pretty strong rally. And that makes me think that the odds slightly favor the upside breakout. R1, what I was saying is the 60-minute chart, probably buyers below on the open. And then with the rally, I thought the rally late yesterday was strong enough that the odds favored some kind of second leg. And because of that, give me just 1 second. Because the odds favored some kind of second leg, I thought the reality is traders looking to buy and scaling lower, we're probably going to make money. And therefore, bar one, it's a low probability sell below. We may get a small second leg down, but I suspect traders are buying and scaling in lower. And then two, not a great stop order buy above, probably buyers below. So first bar of the day, we have a gap down. Well, we have a small gap up and we have a bear bar, but it's a weak stop order sell. And the one thing I'm thinking about on the open is that rally up to yesterday's bar 74 is probably strong enough that the odds are we're going to get some kind of retest. And that's why I had that line drawn right here. My thought is, at a minimum, we're bulls who bought 74 and scaled in are probably going to make money. Two, we have a follow-through bar for the bears, but it's really not a great sell signal bar, and therefore there's probably more traders buying, scaling in lower than selling. Now, what about buying above two, stop below the too low? It's low probability. You're in the middle of a tight trading range, and therefore really not ideal. Come on here. There we go. Three, we have a doji. We broke below the tight trading range and reversed up. Is it a great buy signal bar above? Well, not really. If you really want to buy on a stop above the 3 high and put a stop 1 tick below 3, really not ideal. Increases the odds that we may end up pulling back more. And then 4, we have an inside bar, but again, it's a doji, not a great stop order buy. And therefore, we have a 4-bar bear micro channel with dojis and overlapping bars. This looks like a bear leg and what will become a trading range, which still makes me think that we're probably going to find buyers somewhere below, but we may have to fall a little bit lower. And then we have a bear bar on bar 5 closing on its low. That's a strong enough bar, and it makes me think we'll probably end up will probably end up testing lower. And then we have follow through on 6. That's good for the bears. Now, what about still testing lower? Well, now my problem is there's probably buyers at the 3 low. And even though we have consecutive bear bars, 5 and 6, I suspect we're probably not going to go a lot lower before we try and reverse back up. 7, we have a bull bar closing on its high. What about buying above it? It looks like a good bar, but from the context, there's a little bit of an issue with buying above 7, and that is it's a micro channel from bar 1. So it's 7 bar micro channel, even though it has a lot of overlap. It's an okay buy. We have a tail below the bar. Body's not all that big. A couple ways you can handle it. One, you can buy above 7, stop below 7, and then you buy again if we get another bull bar. Or you can buy a half size position. So let's say you trade normally 2 contracts. You can buy 1 contract above 7, stop below 7, and then if you get stopped out, you buy 2 contracts above bar 9. And then the other option is you can use a stop, some sort of wide stop. For example, you put a stop 2 times the range of bar 7. 8, we went outside down. The bears tried to get the breakout below the wedge. Well, it's a good bar for the bears. My overall concern is probably going to be more traders buying around the midpoint of the rally to yesterday's bar 74 than sellers. There's probably more buyers down here. And then 9, we formed an inside bar. It's second entry buy. It's a failed breakout below the wedge bear flag. The wedge bull flag. And that makes me think the odds are always in bears. If you're short, you're definitely getting out of shorts above 9. And the bulls who bought above 7, 8 did something interesting. The bulls that bought above 7, and they put a stop 1 tick below 7, hoping that it was a wedge bottom and a wedge bull flag that would lead to an upside reversal or an upside breakout. Bulls that did that, they got stopped out on bar 8. And what are they going to do on 9? Well, they got to buy again. So you have bulls trapped out of a winning trade. And you also have bears trapped into a losing trade. You had some bears selling below 7 or selling the close of bar 8, hoping that we'd get a downside breakout of the wedge bottom, and instead of basically falling for a measured move at the opening range. And instead, we formed a bull bar. And that's a good example of, in general, 8's not a great stop order sell, but in general, it's better to sell. It's better to sell on a stop instead of selling the close, because sometimes you get situations like this. And it's the same thing if you're going to get out below a bear bar. Sometimes you get a situation like 9 where the bar 8 fails to trigger and 9 reverses back up. So the bulls, they buy above 9. Bears, they sell out. They buy back their shorts above 9. 10, you can see we went outside up. Good for the bulls. That's a strong enough entry bar. Makes me think we're probably going to get some kind of second leg up. So that's good. And then 11, now we have 3 consecutive bull bars, 9, 10, and 11. Probably up back to always in long. I think we went always in long above 9, but now we're clearly always in long. And I suspect we're going to get a second leg up and a tested bar, yesterday's bar 74. Now, what about the bulls who bought the 74 close? Obviously they would hold overnight, but theoretically, let's just pretend this is one whole chart. What about the bulls who bought 74 and scaled in lower to the 8 low? What are those bulls going to do? Well, if you think about it, some of those bulls, they'll exit on the close of 74. You have other bulls, they'll look at this and think, yeah, maybe that's pretty strong. If I bought here and bought more down here, maybe I should give it a chance to see what the breakout looks like. Now we have another bull bar on 12. That's not a good reason to sell. And now I have another strong bull bar on 13. That's a strong enough bull bar that makes me think we're always in long, and we're probably not going to pull back all that much. Let me say it differently. That's a strong enough rally that the odds of the bears getting a major trend reversal and a successful double top with bar 74 is low probability. And therefore, the first reversal down is probably going to be minor. So the bulls, it's reasonable for some bulls, if they bought anywhere in here, they bought the close of 74, they bought more lower. Some of those bulls will set a target, basically 1 times the range to the upside. And basically they'll bet on a symmetrical second leg from this rally, yesterday's bar 70 to bar 74. Bar 14, we have another bull bar. So we have 6 consecutive bull bars with open gaps. That's a sign of strong buying. Increases the odds of the first reversal down. It's going to be minor. And now bar 16, we have a 7th consecutive bull bar. One of my concerns right now that I have for the bulls is, one of the concerns I had at this point is too many bull bars up in a row. And a lot of times when you start to get too many bull bars in a row, it increases the chances that the market may have to end up going sideways or pull back. So for me, I'm really not interested at this point. I'd rather wait and see the market go sideways. I don't think we're going to pull back all that far, but I also don't think we're going to go a lot higher without at least going sideways. 16, another bull bar. Now we have 8 consecutive bull bars in the rally. Probably not going to get a 9th. And if we do get a 9th consecutive bull bar, we're probably not going to get a 10th consecutive bull bar. And we got a 9th consecutive bull bar on bar 17. That's good for the bulls. But again, we're just getting more and more climactic. And the more climactic we get, the more likely we're going to have to go sideways and undo the climactic behavior. If you think about it, traders will see this as unsustainable. Just if you really want, download 5 years of data in Excel. Download 5 years of TradeStation data or the Emini data for the RTH. Use something like Claude, which you can plug it into Excel, and just ask it, how many bars. I've done this before. You can just ask it between the hours of 8:35 Central Time and 15:15 Central Time. So basically, bar 1 to bar 81. How many micro channels did you get that were greater than X number of bars? And basically, you'll start with the whole point. I'm not going to belabor the point, but the whole idea is you'll realize that the odds of getting 9 and 10 bar micro channels, they're low probability, and they usually get a second leg, but they typically have to pull back. And then we have another bull bar on 18. So what is this? 10 consecutive bull bars in the micro channel. Probably not going to get an 11th. And then we finally got an 11th. And you can see the bars are getting smaller, increasing the odds we're going to pull back. And we finally got a bear bar on bar 20. What about selling 20? Absolutely not. Do you really want to sell after 11 consecutive bull bars in a row? Probably not. And then 21, we have a doji. It's a bear bar. It's a smaller bear bar than 20. And it's a pause. We may get a small second leg down, and therefore 20 is a bear breakout. Pause 21, we may get a small second leg down. But if we do, I suspect there's buyers not far below 21. And instead of getting a second leg, we just immediately reversed up. So the bulls who bought here, scaling in lower, got a second leg. And then 22, we have a bull bar closing on its high. It's a strong enough bull bar that I think we'll probably get another leg up. And then 23, doji, it's a bear bar, not a great sell for the bears because of the bull bar 22 and the fact that we're always in long. But because of the 3-bar micro channel, 19, 20, and 21 not being a great buy signal bar for the bulls, I suspect there's going to be more traders selling above 21 rather than buying it. And then we got a doji 24, and you can see we went sideways for the next several bars. What about selling below 29? It's a triangle. It's really not ideal. In general, whenever you have a strong rally, which we got to bar 19 right here, the odds are you're going to get trend resumption. And then as you start to continue to get sideways trading right here, the probability begins to reduce down to around 50% for the bulls, 50% for the bears. However, the odds always slightly favor the bulls. And because of that, even though it's close to 50-50 in breakout mode, I think it's it's probably 54% bulls and 46% bears. So it's slightly more bullish than bearish. And then bull bar 39, but low probability, and it failed to trigger. We got a second leg down. Excuse me, I said bull bar 30, low probability. Then we got a second leg down, 31. but probably more traders buying 31 than selling it. First test the moving average in over 20 bars, probably minor. And then we got follow through selling on 32, but do you really want to sell consecutive bear bars at the moving average and a possible fail break out of the tight trading range, bars 18 to 31? Probably not. It makes me think we'll probably get a reversal up. 33, we have a bull bar, not a great buy above, but not a great sell either. From a location standpoint, it makes more sense for bulls to buy than to sell. But buying above 33, which is overlapping 32, and the tail above 33, really not all that great of a buy. But if it got to do anything, it'd probably be long betting on a second leg up. And because of this rally here, it's strong enough that we're probably going to get some kind of symmetry. So leg one, pullback, and then a large leg two. If you think about it, a spike in channel is a leg one equals leg two. And the channel is usually comprised of two smaller legs. So that's why, technically you would see this as leg one, leg two, and leg three. And a lot of times the reasons, why do wedges typically form? That's because on a higher time frame, that wedge is typically a large second leg that is nested into two smaller legs. A very simple way to think about that is when you get a breakout here and you get a pullback, usually you get some type of symmetry with the breakout. However, because the second leg is often weaker than the original breakout, that symmetry, in order for it to happen, takes many, many bars. In this case, we had 4 or 5 bars up, and how many bars from this point, from the lowest point here to the end? It took basically an entire day. So that's my idea of symmetry. And anyways, the reason I don't get lost in the point there. You can buy betting that we're going to get closer to symmetry. A lot of times when you have something really strong like this, usually you try and get relatively close to symmetry, 75, 80% symmetry. So somewhere, maybe up here. Consecutive bull bars, 33, 34, good for the bulls. Probably going to get some kind of second leg up. And then we got a pause on 35. And you can see we started to go sideways. 36, we talked about that. 36, really not a great sell below the bar. It's forcing bears to sell at the moving average, really above the moving average. And that lowers the probability for the bears. 37, bull bar closing on its high. Not a great buy for the bulls. Increases the odds that the market is probably going to go. It increases the odds that the market's probably going to go at least a little bit higher. And then 38, follow through buying, good for the bulls. Or 37, I got sidetracked there as I was talking. 37, it's a decent bull bar. Probably not going to go a lot higher, but bull bar, probably always in long. Probably an okay buy. 38, not great follow through. Increase the odds there might be more traders buying a pullback, rather increase the odds they may pull back. But so far, not a good sell. And then 39, it's a high one buy after in a second leg up, rally, pause, second leg up, high one. But, again, not a really all that great of a buy signal bar here. And that makes me think that we may end up going more sideways. 40, we try to get the bear breakout, touching the moving average and reversed up 41. To me, this looks like we're starting to form, a fairly tight bull channel. And that the market may break to the upside. 42, bear bar, not a great sell, probably buyers below. And then 43, we went outside up. That's good for the bulls. Increases the odds. We're probably going to go at least a little bit higher. And then 44, doji. To me, we were breaking out of this trading range here. That's not all that great of a buy. And it increases the odds that there's probably going to be sellers somewhere above. Plus, I talked about the 60-minute chart. One of my overall problems with today is, we have this high one. It's a weak high one with a weak buy signal bar. And because of that, typically when you get a weak buy signal bar, such as this high one here, and you break above it, usually within, how many bars? 2 bars, 4 bars, somewhere in there, usually gets tested. We had a decent bull bar here and a pause, and now we're getting a bull bar here. That made me think that this is probably a leg in a trading range. Bear bar, 45, but not a great sell below the bar. And then we finally got the little bit of the surprise on 46. What about buying 46? You can take the buy. It's probably a strong enough surprise that we'll get a small second leg up. But if we get a bear bar closing on its low 46, I suspect, or 47 if we get a bear bar closing on its low, I think it's reasonable to get out below. And then Doji 48, not a great sell below the bar. 46 is probably strong enough to get at least a small second leg. And then we got the second leg up on 48. 48 to me is climactic. We rallied 46, paused, and if you remember what I said on I said about, why didn't I buy 46? Why didn't I buy during 48? And I made that comment that I don't want to exit below the very next bar, and therefore I'm going to feel bad if we get a bear reversal bar. So if I bought 46 and then 47 is a bear bar closing on its low, I'm going to feel bad having to get out for a loss. If I buy the close of 48 and 49 is a bear bar, I'm going to feel bad having to get out below the bar. And that's why I was unwilling to buy up there. But I didn't want to sell because we don't have a clear sell signal bar. And then we got the surprise on 49. I thought 49 was probably strong enough that the always in bulls are exiting below the bar and always in bears can sell, betting on a second leg down. 49.50 consecutive bear bars, strong enough breakout and follow through, or reversal and follow through in this case. Reversal and follow through is pretty much the same thing as a breakout and a follow through. But either way, strong enough reversal down with follow through. Odds are we'll get a second leg. Tail below the bar on 50. Probably we'll get a bounce. Then we have a Doji 54. Not a great low one short below the bar, so probably more traders buying below. Because of that, even if we get the bounce, I still think that 49 and 50 are strong enough for another leg down. And therefore, there's probably sellers not far above the 51 high. 52, bull bar, strong enough bar to make it at least a small second leg up, but probably sellers above 52 and sellers at the breakout point, 48 low. We had a micro channel, 45 to 48. And 48 is a relatively big bull bar. It's not a great buy. Context is bad, but it's probably not a great, from a stop entry signal bar perspective, 48 is not a great stop order sell below the bar. So there's probably more traders buying below it, even though it's a late leg. And I certainly wouldn't buy it because of the risk of it being a late leg. You can go back and listen to the recording of kind of what I said there. But point being, there's trapped bulls. Bulls who bought the 48 low, scaling in lower, trying to get out on the bounce. Bears who didn't sell below 48 because it was a bull bar are trapped out of shorts, and they're looking to sell on a bounce. Follow through 53, good for the bulls, but tail 52, small bar 53, makes me think the upside is probably limited. And then 54, bear bar, probably buyers below 54 and at least a small second leg. But one of the problems with 54 is, yes, buyers below the bull bar 53. But now, you're probably not going to buy below 50. Let me explain this. It's kind of a long way to explain it, but I think I have to explain it this way. If you're going to buy below 53, the range of the bar alone is 5 points. And that's a relatively small bar in today's price action in terms of the average bar range. So if you buy below 53, are you going to set a target at the high of 53? Let's say you do. You can see you almost got stopped out even on the pullback of 54. But if you bought the low of the bar and now 54 is a bear bar, it's a bad stop order buy above the bar. You're not going to stay long. And that's what happens. It happens a lot, actually. You had, try to find another example of it. I'm not finding it, but anyways, I think you get the point. If you buy below the bar and you get a weak buy signal bar above, there might be more sellers above, and that's what causes that. And you get another doji, and then you breaks the downside on 56. 56, trying to get a bear breakout and a test of the 51 low. I still think, I made the comment about the bar one high. Bar one high is 68.06, and that's the high of the first hour on the 60-minute chart. It's a weak buy signal bar following the surprise breakout late in the day, probably going to get retested. And therefore, I thought the risk was real that we'd have to come back down and test the high of bar one at some point later today. If you remember 57 triggered the sell below 56 and then started a rally. It started to test the upper third of bar 56, and it formed a bull bar at that point. It was forming a bull bar trying to close on its high. And my one thought was 56, 57, as it was 57 went down a little bit and then started to reverse up. I thought that 57 was a lot of risk, forcing bulls to buy in the upper third of the prior bar and the middle of this tight trading range. And therefore, it was actually a weaker stop order buy than it appeared. And then all of a sudden, the market started to quickly sell off and get bigger and bigger. And then you knew, obviously, we were testing down to the high of bar one in the open of the day. 57, strong enough surprise, probably going to get a second leg down, so it's okay to sell the close. My only reservation with selling the close is risk reward. 57 is 34 points, and it's undoing all these bars to the left. So what's the probability that if you sell the close at 57, the market's going to fall another 34 points or 35 points before it pulls back? That's why I was not interested in selling here. I thought this bar is too big. It makes me think we'll probably pull back. And then 58, I thought 58 was a problem for the bears. Even though it's a bear bar, you can see bulls who bought the 50, the 30, bulls who bought the 32 low, scaled in lower during 56. And what happened? I say that's actually not true. They didn't scale in lower during 36. Bulls who bought the 32 low and they got filled during 57. Do you remember what happened? 58 immediately went up, testing the 32 low, and then went back down. So if you're a bull, if you're smart, if you bought the 32 low during 56, which is not ideal, this bar is getting too big. If you did take that buy, and then the market went all the way down here, a lot of traders would immediately try and get out back to 32 low. And that's what happened right there. And that means that there will be traders selling around that area for a second leg down. 57, 58, strong enough to get another leg down. And then we have a bull bar 59. Probably sellers above in a second leg, but it's two legs down here and then here. And the 60-minute chart is fairly tight. I think it reduces the probability we're going to go a lot lower. Bull bar 66. Excuse me, bull bar 60, but not a great sell below the bar, so may go a little bit higher. And we may try and test up to the 52 low. Now we have three consecutive bull bars, 60, 59, 60, 61, but tail 59, tail 60, and then tail 61 makes me think we'll probably end up pulling back and going sideways. And then we got a bear bar 62, but not a great sell, probably buyers below. And then 63, doji. We may try and form a triangle in breakout mode as the market decides if we're going to get a second leg down or if we're going to reverse back up. And you can see we started going sideways for a lot of bars. 65, 66 consecutive bear bars. 66 is good for the bears. I still think the odds slightly favor testing down here. The only problem I have is the overall math on the trade. I'm not quite certain that the math isn't ideal. 67, doji, if you're selling here, stop it goes, maybe above 65. And I'm not certain that there's a 60% chance it's going to go all the way down here without pulling back. You can take it for a swing. You can sell, stop above, and hold, and try and go for twice your risk. Then we got a bull bar on 68, but not a great buy above the bar, probably sellers. And then 69, we have consecutive bear bars. That's good for the bears. That's good for the bulls. But we have a tail 68, tail 69. Makes me think we'll probably bounce and try and test somewhere up here. And then we tested the moving average on 70, but lots of overlapping bars. To me, 70 is good for the bulls, but why is it stalling right at the moving average? And why is it stalling at the 32 low? To me, that's disappointment, it's disappointing. And the bulls have not clearly broken out of the triangle. So there's still 50% chance that this reversal fails and goes the opposite direction. And that's what happened on this bar. Strong enough surprise, we may get a small second leg down, but probably buyers not far below. And then the bears got a surprise 72. So we may go a little bit lower, but I suspect probably not a lot lower. And then we got another consecutive bear bar 73. sellers above, and then a second leg down. But bulls who bought anywhere in here and bought more lower were able to avoid a loss or make money. And that's what led to the rally right here. It's kind of another example of symmetry. So we have a big bear bar 57, and the bar is relatively big. It's reasonable to assume that you're probably going to get some kind of second leg. And maybe based on so we have a sell-off and then a pullback, and you can see we came to about 80%. So the distance, if we treat this as a breakout bar, and all the way to the 57 low is the first leg down, so bear breakout, follow through. I know you could do from the high of the swing point, but I'm assuming this is the bear breakout here, and this is the pullback. You can see the market came really close to a symmetrical second leg, but you can see how many bars it took. Here, it was 3 bars. Bar 55, and then 56, and then the bull bar 57, we pulled back, and then we went sideways, 61 to 78. That's about 18 bars. So it took 3 bars to make this bear breakout, and then it took 18 bars to make an attempt at a symmetrical second leg. And that's why it's basically a spike and channel. It's the logic of a spike and channel. Channels usually have significantly more bars than the spike. For stop orders, at the first credible buy, you buy above bar 9, you buy above 7, and I talked about how you manage that. You get out below the bar, or you use a stop, maybe a measured move of the signal bar down. You can also trade a half size and buy more below 7. You can buy 1 contract below 7, half size position, and then you can, if you get stopped out below 7, you can double your position on bar 9. Many ways to go about it. And then buying above 9, that made sense. And then it was always in long all through here. And then really, as far as where do the bulls have to get out, some bulls will get out. Some bulls like me will just get out up here. And that's because too many bars in a row, odds are we're going to have to go sideways for some period of time. And I don't want to just sit there and as the market does this. But realistically, you don't have to, you can get out below the double top 23 and buy again above 26. But none of this is really all that ideal. Maybe you get out below 31, but then you buy again above 33. But again, tight trading range. I think it's really hard to trade with stop orders. You can buy above 37 and no reason to get out. Maybe you get out below bar 40, but I made the comment, ideally you want to see a strong follow through bar on 41. You never got it. If you get out below 42, I don't think you have to. 42, you can, but 42 was testing the midpoint of 41, so that it went 1 tick below it. So bulls, rather than buying the close of 41, they set a limit order at the midpoint of the bar, taking a chance that the market would give them 1 times the risk or 2 times the risk. So instead of buying the close of 42, stop below 40. Instead of buying the close 41, stop below 41 and going for 1 times the risk, they buy a 50% pullback of 41, put a stop below 41, and then go for twice the risk. And then bears, bulls obviously get out below 49. Bears, they can sell there. I don't think they have to get out of shorts here. And then where do the bears get out? I think you probably get out above 57. It makes sense. Or above 68. It's probably okay. And then if you get out, do the bulls buy 68? Some might. But I made the comment, a little bit low probability. And then 72, not a great sell. That's probably it for the rest of the day. For limit orders, I thought probably buyers below 1, scaling in lower. And really buyers anywhere below scaling in lower. But you need a really wide stop. You got to be able to trade small. Otherwise, I'm really not interested in selling anything until some sort of test is satisfied. And then I thought buyers on the first reversal down, but after 10 or 11 bars up, Not great, but you can do it. And then all through here, limit order trading, but fairly difficult. You can buy at the moving average, betting on a bounce. You can buy below 39, but tight trading range. Really not ideal. And then I thought it was okay. If you're really determined, maybe you sell above 47 and scale in, or sell the close of 48. Probably okay. Betting on the wedge top, but that's pretty advanced. And for me, I'd rather wait and see the reversal. And then I thought sellers above 51, scaling in higher, and probably buyers below 61. But I'm not really interested in doing much with limit orders through here. And then buyers below 75, buyers below 76, but late enough in the day, a little bit dangerous. And then buy the close, sell the close. It was definitely buy the close on 11, 12, 13, 14, really anywhere in here. And then you could buy bear bars, but a traditional buy the close, sell the close, and buy the close through here. I thought, technically sell the close 50, 56, but it's probably better to sell the pullback instead of sell the close. So I'd rather look to sell up here than sell the close at 56. And that's probably it for buy the close, sell the close. Let me take a look at a few questions, and then I'm going to wrap this up. Someone said, thanks for everything. And they've been rewatching the March 3rd session where I talked about the stop orders. And they said that they think stop orders could be the game changer. Well, yeah, I think your realization of stop orders is important. And I'm going to look at March 3rd. If you think about stop orders, so stop orders are relatively important for several reasons. A stop order is a breakout by definition. So any bar, we'll just use today. Every bar that's a breakout bar is a stop order. And if you're willing to buy, if you think about it, a buy the close bar where you buy, let's say you look at bar 13 and you just say, I'm going to buy the close of bar 13 at the market. That's no different than buying on a stop above 13. It's the same thing. The only difference is you're buying the close, you're front running the stop order. And if you're willing to front run the stop order, you're eager to get in, betting that you can get in at a better price and the stop order is still going to trigger. And therefore, really what you're saying is it's stop orders are important. That's what I'm saying. They're important because if you think about it, a stop order by definition is a breakout. Because a breakout is price going one. A breakout is really dependent on your minimum definition of a breakout. Price going one tick above or below the prior bar is a breakout. A stop order price going one tick above or below the prior bar or previous bars. It's all the same thing. And so really what it comes down to is understanding the strength of breakouts and the likelihood of a breakout getting a second leg. So for example, I talked about this over here. It's a really strong surprise. It's a breakout. And the odds are really high that that breakout is going to get some kind of second leg and some kind of attempt at a symmetrical second leg. And therefore, what does that tell you? It tells you that this sell-off is probably going to be minor and lead to a trading range. So traders buying and scaling in, probably going to make money. This was far too strong. It's a breakout. It's all stop order buys. It's strong enough that the odds are traders who buy and scale in are going to make money. Over here, 49, that's a problem for the bulls. We have 3 pushes up, 1, 2, 3, relatively close to symmetry, trying to break out of the bull channel. That's a reasonable stop order sell, betting that we're going to get a breakout and some kind of second leg down. And then you got a really big bar here. Even though I didn't want to sell it, it's a reasonable sell, betting on another leg down. And so you're right. Overall, stop orders, I think stop orders are one of the single most important things to understand. And basically what that means is, let me say it in 2-part. You have to understand breakouts and why breakouts get second legs. And in order to do that, you have to understand stop orders. So it's kind of the same. I see it as the same thing. Obviously buying bar 9 is a stop order buy. It's not technically a breakout. Buying above 9 is not the same thing as looking at 4 or 5 consecutive bull bars and saying, yeah, it's a breakout. But the concept is the same. If you're buying on a stop above 9, what you're doing is you're front running the breakout. You're buying early, anticipating that the market's going to break to the upside. If you wait and buy bar 13, you're just buying the breakout, but it's the same overall trade. Obviously, the math is slightly different. Buying above 9, the risk reward's better, probability slightly lower. Buying above 13, probability is on your side, but the risk reward is bad. Okay, question. I bought above bar 7. Okay, I think that's okay. I talked about bar 7. For a 50% pullback reversal. Oh, I see. So I bought above 7. They bought above 7 because it was a 50% pullback of, I believe, this rally here. When bar 8 closed, I thought the bears had momentum and sold. Oh, I see. And okay, so they bought above 7 here. And then when 8 closed as a bear bar, they sold at the market, and then they got stopped out, I'm assuming, above bar 8. When I see bar 9 through 11, I saw always in long, but too afraid to take the trade, then missed a big trend. Any comments on that? Yeah, that is something I can say a lot about, and it's happened to everybody. It's very, very frustrating. You think about it. I can't tell you how many times I've done that, but it's countless times at this point in my trading experience. But the point is, you buy above something. It happens to all of us. You buy above 7, and then you think the market is reversing, so you sell. But you already lost on 7, and then you reverse on 8, and then you lose again. And then by the time you see the reversal, you're paralyzed because you can't imagine taking another loss. And you're kicking yourself in the teeth watching the market go up, and you're furious. I get it. So how do you prevent it? You have to define. This is why I always end. Let's think about trends. So let's think about the market. The market forms a breakout, which is a trend, and then it pulls back into a trading range, and then it forms a trend. So I think this is a good kind of ending conversation that everyone can ponder through the evening. My mouse will cooperate. There we go. Okay. Let's do like this. We have 1. Yeah. We have 1. I don't like any of this. This will work. Okay. So drawing with a mouse, so bear with me. So +1 is bull trend. 0 is TR, trade range. -1, bear trend. So what is this? What this means is the market can never quite go to, it's never going to be, at all times, the market is oscillating in between these numbers. When the market is doing this, it's in a bull trend. It's a strong breakout, but it's never going to be +1. It might be 0.95. Price, it's like I forget the math term, but it can never exactly reach +1. It can never exactly reach -1, but it can get really close. So the market, as the market starts, is a trend. It's really close to 1, 0.95, 0.9, something like that. And as the market starts to pull back, what happens? Price starts to approach trading range. It starts to become more and more neutral. So probability, like +1 is 60%, 70% for the bulls. It's trending. And then as the market starts to pull back, it becomes less of a trend and more of a trading range. and then the market gets more and more closer to zero. But in order for the market to go to negative bear trend, -1, the market has to actually break beyond a trading range. And it takes a lot of time and energy for a trend to form. So the market cannot go from +1 bull trend to -1 bear trend in a couple of bars. And that's why a lot of times what happens is market goes to bull trend, gets down to zero, and starts trying to become a bear trend, but it doesn't quite get there. And right when it attempts to become a bear trend and fails, all of a sudden its trading range down here, all of a sudden the bear trend fails, it's a trading range, and the market reverses back up into trend. That's the easiest way I can explain it. So in other words, how do we relate that back to what Al says in the material? If you go back to the books and watch the video course, Al talks about how a lot of times in the market, when the market's in a trading range or pulling back, it's basically the same thing in this case. When the market is, trying to get rid of this, there we go. When the market's pulling back, a lot of times the market gets really, really close to making you think that the reversal is successful and the market's always in short. And you think to yourself, the bears probably need one more bar. Well, bar 8, it looked like the market may fail and break to the downside. And you look at that and you think, yeah, the bears probably need at least one more bar. So if 8 is a bear bar, and then 9 is an equally strong bear bar, then the market's probably always in short. But without it, they probably need one more bar. And that's what happened right there. And the biggest thing, you got to be really careful reversing. And a lot of times you got to check yourself, because sometimes reversing a position might just be reversing out of frustration. Dang, I lost on my trade. I'm really upset. I'm going to reverse the trade and try to make it up. That's not the right way to look at it. You think about it from the standpoint of, okay, I'm selling above a bar, knowing where this is a bear leg in a trading range. And if the market starts to form, let's say I sell the high of a bar, and if I get a follow through bar or a couple of follow through bars, this might reverse into a bull trend and get some kind of symmetry. Therefore, I need to get long. I hope that answers your question. But the point is, the more trending behavior that you have, you got to be really careful with reversing. All right, so as far as tomorrow goes, it'll be interesting to see what we get. I think overall, we have enough. We have a low one short today, and I suspect probably going to find buyers probably below. And if today is not a strong stop order sell, I suspect we may just try and, so it's a couple things. We may trigger the sell, then rally. What are the chances we get a really big bar tomorrow? I think it's low. This is a big enough doji. There might be sellers in the upper third of the bar. But I suspect yesterday's outside up bar is strong enough that we'll get some kind of second leg up. So I think we're going to test back up here over the next several days. But we'll see. All right. Thanks, everyone, for listening. And I hope everyone has a great rest of their day as always. Okay. Thanks, everyone.